Okay, very good morning. Thursday, 16th of February. Hope you all had a good evening. Just kind of the first thing that I do when I come in is switch the TV on, start to hear what the likes of Bloomberg TV are talking about. And one of the interesting things is a lot of the market pundits that are on, they've had a guy from Barclays, Credit Suisse, I think there's a guy from one of the US banks as well this morning, and they're all obviously getting asked about some of the movement in which the market saw yesterday. Because really, over that almost 2-hour period since when the CPI retail sales report hit, and then about 2 hours after, there was a complete sea change in the kind of market, especially in the dollar and US yields. And listening to most of these pundits, really, a lot of people are struggling to put a real finger on why did a lot of that occur. And I think it is a good example. I was talking to some of the guys in stage 1 of the career program, and it's just that sometimes actually you can't try to figure out every single ebb and flow of the market. You can't try to pin it on a fundamental reason why it's doing it. Sometimes you've just got to react and act with the price action that's just kind of unfolding in front of you and go with it. You did get definitely a feeling like that yesterday, but there are a couple of things I guess you could look at. Well, firstly, let's just take a look at the way that really the CPI data. So it came in at the biggest increase in nearly 4 years, and obviously we're getting to a point where from a Federal Reserve mandate or an objective in terms of the employment and the inflation situation, we're getting at levels now where on those measures you would argue that really the Fed should be hiking in March. You also had, coupled with that, the retail sales report, which came in higher than expected, decent as well, upward revisions to prior months. That was a measurement as well of January, which although I think it was auto sales were weak, that was as anticipated. The fact is that usually January is a fairly benign month, I guess, after a blowout kind of Christmas period with that seasonality of just general trends of consumer spending. But actually underlying in the retail sales report, consumer spending was fairly healthy on those measures such as clothing and so on. So good data caused that immediate kind of elevation in the dollar and US yields. I mean, just taking a look at the 10-year over a couple of the things that we've seen this week. You've had that big move lower when Janet Yellen spoke, and then that was the other big candlestick to the downside yesterday when that data hit. Only though for that entire move to be recovered. The Treasury market took a little longer, but the FX market was a lot more shorter lived. Now you did have the industrial production number. I think that was the biggest drop that we've had since, I think it was September of last year. And then I think there was a couple of technical levels definitely that I was looking at in cable yesterday that were quite relevant for recent price action. And we just move that. So really, it was really looking at the end of last week on Friday. There was that level around the 2450 type mark, which provided support as well back on the 14th. When we broke that yesterday, that was quite significant. We had a run all the way down to S2 on the day. And then when we came back up, we broke through when we were recovering post those economic data points I was just mentioning. And extension high immediately ran up towards pivot before coming back and then finding a bit of support again around that level. I guess from going forward now, although we're up to testing close to R1 this morning and sitting on the 125 handle, any move back down towards, I guess, what is today the daily pivot, I think it's a pretty good level to keep an eye on. Should we get down back that low again today. So again, like the oil figures that we had yesterday, when you had what is really a bearish report, looking at headline builds of nearly 10 million, and then the price just ramps back up shortly after release. Again, it's more about, I guess, pattern recognition and being able to be flexible enough to think, I just got to go with what I'm seeing and not try to overthink it which I think can be a case which can happen quite a lot in a session like yesterday afternoon. But a couple things I wanted to show you charts wise or graphic wise this morning that are drawing a bit of attention. And this is obviously last night you had another higher close in the US indices. The S&P yesterday, the move was the 7th day in a row that the index has finished up, which is the longest run now since September of 2013. So you're getting consecutive positive moves for the first time we've seen in multiple years. Now looking at the MSCI ACWX, so just look at this as that kind of a global benchmark index. Bloomberg just pointing out in their articles this morning that if you're looking at the RSI on that, we're kind of really at that point of being overbought as we were coming in the summer of 2014. A lot of talk obviously about any near-term rate hike you would think would be met as a net negative, just given the fact that equities have been elevated by this accommodative period or very slow gradual process from the Fed of rate normalization, and given the fact that we're overbought on these types of measures, it's kind of ripe for a bit of a pullback. This also comes with the VIX yesterday, saw a rare double-digit move higher. It's only the second double-digit rise that we've seen since November of last year in terms of the VIX. One could argue though that since when has an overbought market and a spike in the VIX ever stopped US indices going higher? Hard to kind of disagree with that, but if you're looking at these types of measurements, it's hard to look and kind of maybe see some of the market's hesitation, I think, in buying too much into this reflation trade from Trump. It seems as though the markets are now acting a little more cautious as the reality starts to come in that actually this could then be rate hikes occurring from the Fed. The other chart then, looking at that and talking about the Fed, is the probability of a rate increase for March. We were talking really at the beginning of the week, March was really a bit of a not a non-event, but a very slim probability that the Fed would move rates higher at that time. We were looking at 30% at the beginning of the week, but then you had Janet Yellen. Obviously, it's the first testimony she gave to the Senate on Tuesday, when she said really the main takeaway point there was that it would be unwise to wait too long before lifting rates. That was the essential take-home. Yields spiked higher, probabilities rose. I think it was really from 30 to 36%. You've then had Trump yesterday. He was also quite vocal in his press conference, talking up again this idea about this phenomenal tax plan upcoming. And then you've had the data with the CPI and the retail sales report yesterday, and now we're sitting at odds of 42%. So we've gone from 30 to 42% in the matter of about 4 days in terms of a rate rise happening in March. I would say the consensus on Wall Street as a whole is still that, and as really reflected in the way the markets are priced, March is still not priced in at this point. It's just the likelihood of it has increased. June is still what most on the street are expecting. If you think about it from a Trump point of view, which is a very important piece of the jigsaw puzzle, although he's been talking up this corporate tax plan, we still don't really have any definitive details of its shape or form or timeline as yet. And you would think that that would tie the hands of the Fed, possibly, or if they needed any type of reason to be cautious, then that's a perfect thing to pin it on. Nonetheless, though, you have Fed speakers late last night. If you don't recognize this chap, this is Dudley. Now, Dudley does carry some significance in terms of commentary because the New York Fed president is a close ally of Janet Yellen. Is quite influential within the Federal Reserve in terms of his comments. He said that the Fed will aim to raise US interest rates in the months ahead as long as the economy continues to grow a bit above its trend, and if, as expected, fiscal policies provide a boost. Now, there's no doubt that fiscal policies would provide a boost to the US economy. That's not really the question. The economic sense is there. It's whether or not Trump can actually deliver, and at what scale is it that these fiscal policies come in. And also, I guess, as well, the timeline and how quickly they come in will as well be a key part. One of the key things as well yesterday, I did see another kind of stat about the banks. So US banks, again, seeing another decent day on the upside. Kind of, it's a double whammy for the bank sector at the moment. You've got twofold. You've got this kind of prospect of rates going up and margins improving, which is something that they've struggled, obviously, under ZIRP or zero interest rate policies in the past. Then you've got the fact of deregulation. And still, even now, listening to a couple of the market pundits on TV this morning, seems to be a little bit of... the market has been quite sensitive to that. Banks have really, really bolted higher, but ultimately what can be achieved, again, it starts to go into this implementation risk, possibly slightly. But again, you can't go against the trend that is definitely forming at the moment, and banks are still leading the way on a sector breakdown in terms of US indices. Talking of Fed months, obviously they don't have to move in June. I thought I'd just quickly bring this up. This is the Fed or the FOMC meeting schedule for 2017. People always talk about March, June, SEP and DEC. They are the kind of, historically, the reason they have significance is because the Fed like to move when they have additional room to communicate any type of policy change to the market, followed up with an updated forecast and projections and their summary of economic projections. And also Janet Yellen then has a press conference and a full Q&A. It's kind of like if you're going to do something, you can then make the policy change and then soothe over any uncertainty or volatility or market concern by then talking directly after the event. That's why they tend to move on those months. But actually there is an event in May. So even if they didn't move in March, what's not to say that they might make a move in May? Let's not get away from the fact that the Fed could still schedule several speeches around the event in order to almost facilitate the same kind of communication tactic that they would with an accompanying press conference with Janet Yellen. So, even though March is not priced in at this point, maybe May might be something that people will start to look at a little bit more closely if they don't pull the trigger in March, because obviously there's a gap here with there only being 8 meetings during the year. There is no meeting in April. Okay, just flicking back to the charts briefly, just watching Euro-Dollar here, just coming up to testing the high that was seen back on the 14th, so 2 days ago, obviously around R1 as well here. So the dollar's just pulling back a little bit this morning. The Dixie is trading down around 1/3%, hence both major pairs are on the front foot this morning. The kind of inverse relationship, you're seeing weaker dollar, gold elevated. Let's just have a look at that high from a few days ago. That was end of last week. We just kind of flirted with that level now at 38 or 39, with 41 sitting upside at R1 in gold as well. So a couple of decent levels to maybe keep an eye on here. In the equity markets, the S&P you can see has been pretty sidelined up at around these elevated record levels. I would say, despite some of the dollar movement, equity-wise, we're still very much of a bullish mind frame. Don't really see anything to really alter that view today. In terms of earnings in Europe, obviously we've been talking about that. It's been a bit of a theme through this week. Earnings season still very much underway in the Eurozone. Air France this morning up 7%, Capgemini up 2.5%, Safran down 1.3%, Nestle, which is a huge company in Switzerland, makes up the large proportion of the SMI index, they're down 2%, and Schneider Electric in France down 2.7%. So a bit of a mixed bag on the earnings front, and starting to see a little bit of a pullback here in the DAX just as I'm speaking, just print at session low. Level there, I'll be keeping an eye on. Downside, you've got that. Really, it was the key level that we were looking at yesterday. When we had that initial run lower, it was that high that we had very early on the 10th at the end of last week that I was keeping an eye on. And this is when we were coming under pressure yesterday, just before we were breaking that respective S2, it pretty much ran some stops, hit that pretty much to the T before then a very aggressive bounce was seen. So that played out quite well from what I still had marked up from what we were looking at yesterday. Well, definitely what you have been seeing is, if you're looking at these indices and timings wise, the DAX is still seeing its usual kind of regular level of volatility, I guess, but the S&P at these types of time, likewise with the Dow and Nasdaq, it's really not to be touched, I guess. There's really not a great deal going on until the US come in. There seems to be a bit of divergence in the US indices are really disinterested in what Europe does in the morning to a larger extent. That being said, remember that the kind of focal point of the markets is still very US oriented. And as such, on that note, just looking at the calendar for today, if you've already looked, you'll see that today is exceptionally quiet in the European morning. There is nothing really of significance coming out of Europe or the UK. So respectively, a couple of those technical points that we were just looking at across asset, I'd be keeping an eye on to play out this morning. But then really you're geared up for the US afternoon, for where most of the price action will come. The ECB minutes very rarely throw out any surprises, so I wouldn't imagine that would be the case either today in terms of any market move on the back of it. You've got the regular US jobless claims numbers, of course, on a Thursday. Housing starts, building permits. You also get Philly Fed. Obviously, we had the New York Empire manufacturing number yesterday, which was forecast busting, is the only way to describe it. I think it was pretty much double consensus estimate. Really strong number. So we're looking out for the Philly Fed figure to come out later. Speakers wise, you've got ECB's COA speaks on financial globalization in the Netherlands later on this afternoon, so possibly not directly on policy itself. So a couple of things to look out for. I would say, again, it's going to be in terms of catalysts for potential market movement. A couple of things coming out the US. Don't get me wrong though, none of these figures are anything to the same kind of scale on a tiered importance nature as the CPI and retail sales that we had yesterday. They are both right up there, especially on the inflation front of key metrics in which the market is looking at, and therefore default have a much bigger market impact. Today's data is a little bit lower down the pecking order, I'd say, but nonetheless, comparative to a non-existent really European UK morning in terms of scheduled events, it could be where the greater market movement inevitably evolves. Okay guys, going to leave it at that. So enjoy your session, and I will see you in the chat room as per usual. Thanks guys.